Hello, my name is Gillian Zhao, China Analyst at Utilico Emerging Markets Trust. Despite multiple challenges, China's economy delivered solid growth in the first half of this year. GDP rose by 5.3%, ahead of the government's 5% target. This resilience was underpinned by three key drivers: front-loaded government bond issuances, expanded fiscal measures, and accelerated exports ahead of the US tariffs. However, renewed trade tensions have cast a shadow. The United States trade deficit with China stood at $295 billion in 2024, making China by far the largest contributor. Yet, exports to the US represent only 2.3% of China's GDP, highlighting limited direct exposure. This year has seen a turbulent tariff cycle, a 20% US tariff in January escalating to 54% by April, before easing back to 30% after Geneva talks in May. By June, Washington had relaxed chip export restrictions and reinstated student visas, as China's strategic leverage is clear. The country controls 92% of global refined rare earth supply, resources the US cannot do without. At the same time, tariffs on other Asian exporters have been raised to between 15 and 25%, improving China's relative competitiveness. Based on our talks with companies during our trip to mainland China, Beijing is also recalibrating its diplomatic approach, balancing careful management of European relations while prioritizing overseas expansions as part of its 15th five-year plan. The July Politburo meeting, which coincided with the US-China talks in Stockholm, underscored a cautious approach as no major stimulus measures were announced, suggesting the economy is holding and Beijing is preserving flexibility for future trade negotiations. Monetary policy remains moderately loose, with a further 10 basis point interest rate cut and a 50 basis point reduction in banks' required reserve ratio expected before year-end. On the fiscal side, the focus is on accelerating bond issuance rather than interim budget revisions. The fourth plenary session in October will be critical, reviewing economic progress and setting high-level five-year plan targets for the Chinese economy. The property sector remains under pressure, and higher-tier cities continue to outperform lower-tier cities. In June, new home prices in Tier 1 cities fell 1.4% year-on-year, while Tier 2 and Tier 3 cities declined 3.0% and 4.6% respectively. Second-hand prices show similar trends. Although the pace of decline has moderated slightly, property investment continued to contract by roughly 10% year-on-year, a trend persisting for more than 3 years. Without substantial policy support, the sector will likely remain in correction mode through the rest of 2025. In contrast, the technology sector has been a bright spot. On-the-ground sentiment has improved thanks to the launch of DeepSeek's large language model in late 2024, which sparked a surge in AI-driven demand for data centers, with Chinese hyperscalers driving new orders. While shortage of advanced chips briefly slowed momentum, optimism returned when the US eased export curbs, and investors and companies alike remain confident in AI's long-term potential. Consumption remains a policy priority, despite the 300 billion renminbi subsidies largely spent, and the stimulus measures have been reactive in the short term. The Chinese government is now taking a more proactive approach to unlocking long-term consumer spending power by strengthening the social safety net, an area that has historically been neglected. New measures include the long-awaited annual childcare subsidy of 3,600 RMB per child under the age of 3 and free public education for the final year of kindergarten. While China still has a long way to go, this nationwide demand-side cash stimulus marks a meaningful step in building a consumption-led economy. Yet, challenges remain. Deflationary pressures are evident, with consumer prices falling 0.1% year-on-year and producer prices falling 2.8%. Many companies we met report ongoing pricing pressure, prompting them to relocate production inland to reduce costs or expand overseas where margins are higher. In response, Beijing has recently launched the anti-involution campaign to address overcapacity and improve efficiency in key industries. Its effectiveness in reflating the economy, however, remains to be seen. To summarize, China's outlook remains a mixed bag. resilient growth in the face of external headwinds, persistent structural challenges in property and prices, but strong optimism in technology. One of the key observations from our trip was that long-term investors are increasingly seeking high-quality, value-driven companies offering attractive dividends against the backdrop that the Chinese 10-year bond yield is persistently softening. For Utilico Emerging Markets Trust, this environment reinforces the strength of our strategy, investing defensive, value-driven and high-quality assets in utilities and infrastructure, which continue to demonstrate resilience amid global market volatility. For more information, please visit uemtrust.co.uk. Thank you for your interest in UEM.